All right, welcome everyone hopping on. We got a whole bunch of people signed up for this. I'm just going to give it a few seconds here to let everyone come on board into the room. Appreciate you joining us so close to the holidays. And by the way, you're going to enjoy this. I'm going to probably say a couple questions and get Greg going. So please feel free to chime in with your questions too as it keeps moving. Couple more seconds here. We had almost 300 signups, so they're entering the room slowly. All right, we'll keep it there. All right, well, welcome. Appreciate it. Simple Numbers Webinar, episode 8, featuring Mr. Crabtree himself. To discuss Simple Numbers 2.0 rules for smart scaling. For those of you who haven't been on this before, my name is Mike Maxson. I'm a partner here at CRI along with Greg. And we're going to get this going and kick it off with Greg telling us why'd you decide to write this book?
Well, you know, it was always that thing of I never knew I'd write the first book, but as we got into it and started applying the concepts, and as you start to pull every idea and to go a little further, you start to learn a little more. And one of the interesting things in terms of our practice in applying the Simple Numbers consulting process to our clients is you see a lot of patterns, and so we just kept seeing other patterns when you go, that's interesting. And it really kind of drove the idea of there were things that I put in the first book that were observations. So it was, you know, when you look at data analysis, there's two levels of authority. First level of data analysis is correlation. So, hey, I see this and then I see this happen. Those two things, they seem to happen quite frequently together, but you can't really make it truly causal. But if you can get to causation of an action to an outcome, then you can start to speak with some authority, on that item. And so a lot of those initial observations that we had, I think I would kind of describe 2.0 as kind of more of the why behind some of those initial ideas and the refinement of it. And a few other things that we just kind of discovered that were sitting there in plain sight that the academic world of accounting has overlooked because a lot of those people never ran a business.
So I know I'm going to get this question again because I've already been getting it a lot, but if I didn't read the first one, can I read the second one?
Yeah, you can. The second book is okay to stand alone. I think there's still, the original ideas of why I wrote the book and why I was just totally surprised. I mean, there's probably, between hard copies and PDF or the print on demands and Kindles, there's probably somewhere 60,000+ it's been distributed to the first book, which totally blew me away. I mean, I never thought it would, have that kind of a reach, but really the second book can be read on a standalone basis. But what we're finding is with the release of the second one, there's a lot of folks that are buying both books together, which is it's kind of nice.
Oh yeah, awesome. Tell us about some of the new metrics that you've put forth in this book. I mean, in the first one, we have the overall, the labor efficiency concepts and valuation concepts. But tell us about some of the things you've expanded on based on your work with our clients here at the firm.
I really think that the major aha came. One of the things I get to do is I get to chair the EO at Wharton Executive Ed program. So I always like to say, a kid from a chicken farm in Alabama gets to hang out with like legitimate professors, and and I get to present some of my material as well as, but it's mostly run by a couple of the Wharton professors. But the first year I was in that program, helping to run it, I get to sit through it. And David Wessel's our lead professor, and I make mention of him in the new book. He was talking about this concept of return on invested capital. And, and it's kind of one of those things that if you're not paying attention, it's easy to throw it away. And he's talking about it, and I'm sitting there thinking, gee, I did that calculation in college. I've never done it for a client. And so so I keep thinking, and I go up to him after the session was over, and I said, well, David, you talk about, you've got data on this with all these public companies, but nobody really has private company return on invested capital information to any reasonable degree, because it's not as simple as taking your profit divided by equity of the business. Equity is an imperfect calculation in many cases. And so what you're doing is refining the true equity number, the true capital number that you invest to produce a return on a consistent basis. And so as he was going through, kind of explaining it, I said, I asked him if he had any interest in studying it, and you find out pretty quickly that college professors don't do anything unless you pay them. So we just kind of struck off and kind of did a study of our own. And I mean, it was the big mind exploding experience, because it solved an issue that I had with the first book. In the first book, I always say, hey, you're at life support profit at 5%, you're a good business at 10% profit, you're a great business at 15, anything above 15, take it while you can get it, and the market will compete you back. And that still works for about 70% of the businesses, but there was about 30% I didn't have an exact answer for. And I also didn't know the why. And so as we ended up looking into it, I now know why. Is we've now established the standard of, we believe in a developed economy, US, Canada, Australia, something like that your minimum acceptable return on invested capital standard is 50%. And so if I have $1 million of invested capital turning over in my business between my working capital, my fixed assets, and cash, that minimum cash that I need to have on hand, if I got $1 million invested, my minimum profit target is 500,000. And that to me is a big aha, and it's really given our clients a lot of clarity, because it really starts to get them serious about affecting the capital components that they can affect, which is mostly AR, inventory, accounts payable, and deferred revenue. These are those, what we call, the term I use for them is trade capital. And so, and we've had some phenomenal experiences that once we've identified this in the mind of the entrepreneur, they just start acting on it. And the best story to tell is one of the toughest businesses to capitalize is the staffing industry. Typically, staffing is fairly low margin. It's not uncommon for a staffing business to make between 5 to 10% profit and struggle to get to that even, but they got to carry a lot of receivables. You don't have anything to get payment support from a vendor. I mean, employees don't give you terms. They want payroll every week. And so, so we looked at this number, and most US-based staffing businesses carry about 20 to 25% of their revenue is held in receivables at any given point in time. And that's what you got to fund. And most people offset it with lines of credit. But lines of credit, as we've learned through COVID, they ain't so sure sometimes. And so realistically, as you're looking at this, we said, well, you got to find a way, can you get profit up and so forth. So I pick up a staffing business client in Australia, and I'm looking at his, and he has AR, but he also has deferred revenue, and deferred revenue is in excess of his accounts receivable. So he basically has negative trade capital that he gets paid before he has to pay anybody. And I said, how'd you do that? And he goes, well, we ask. Really? You just ask. I said, yeah. Because really getting paid in advance is just a question of trust. And as most people, they were dealing largely with large businesses. It wasn't a question, did the customer have the ability to pay? Was the customer, these are fairly sizable contracts. They trusted them that they're going to go do what they do. And they just said, listen, we got cash out of pocket. We would like a deposit up front that kind of sits there and stays in advance. So, and they were nicely profitable, so great business. So I get that CEO to talk to my clients in the US, and they share some information and share the concept. Lo and behold, now we don't get to a negative trade capital, but every one of our staffing business clients in the US that became aware of that idea, they not only increased in profitability because they saw different ways to do it, but they also brought the trade capital down and significantly and finally met that 50% return on invested capital standard, because it broke through the mental barrier of what's possible. And and it's one of the reasons why we don't, we have multiple clients in most industries, but we don't make a point to just be singularly one industry focused, because we can learn something from every industry, and it gives us these patterns to see and then go apply in other places. And it really, I think it's fun to see entrepreneurs see that something truthfully can be done. You're not dealing with partial information from a business media publication that isn't telling you the whole story. We're looking at the truth of the data, and we can go talk to them and say, hey, we've seen this, this is possible. And once you establish what's possible, entrepreneurs are a great group to go make it happen.
Do you have available, because I remember I was with you in the room right behind you as you were drawing it on the wall, the cash power ratio graph.
Yep. Mm-hmm.
I think that probably best explains what you were talking about in terms of being able to essentially fund your own growth.
Yeah,
by utilizing the trade capital concepts.
Yeah, and let me share the screen here, and I'll see if I can pull that up. And so, in essence, what this means is, think of it like this. So with this concept, I refer to it as trade capital. So let's get a little accounting geeky for a second. Most of you know what working capital is: current assets minus current liabilities. Well, I'm here to tell you that the accountant gurus got it wrong. Working capital is a stupid calculation because it contains two things that should never be in there: cash and debt. The thing is, cash is a choice, debt is a choice. The other things are market forces that are forced on you. You can affect accounts receivable, but if your industry requires you to sell on account, it is there. If you have to carry inventory, do you get some trade credit from your vendors, or can you get different vendors that'll give you better terms? Do some of those give you better pricing, but you got to pay them early? These are these net things, and we call it trade capital for a reason, because these are the things that turn over. And this is really the key number to understand: is, do you have what we call a cash flow free growth company? And so if your trade capital, as I said, the staffing business, they were out here. They were trade capital percentage over 15% and at 10% profit. So they would be right here, which means if they decided to grow, they had to have a funding mechanism that wasn't out of profit. They had to go either borrow money or get a capital injection. But when you flip it the other way, the client in Australia, he was at 15% profit, and he had zero. I mean, he was way up here in the hot zone of, hey, grow as fast as you can, because this thing will pay for itself in that process. We have a client right now that's a multi-location retail business, and they've got a model to grow, to 25 stores in a very short period of time, largely because they figured out, one, how to run a profitable contained model. Every time that they open their store, they get profitable really fast. And the fact that they can open every location with almost no capital down. They can essentially finance it over a 5-year period through the SBA 7A program. And essentially that financing payment is the equivalent of rent in reality. And so if you look at that payment as a rent expense, these guys, all they got to do is go execute to grow. And what we found, this is the reason why the subtitle of the book is called Rules for Smart Scaling. If you want to scale smartly, it's called, I got to figure out a way that I can grow out of my own money is by far the most solid way to scale your business. Now, it's not to say that you can't go out and get other people's money. It's not to say that you can't go out and get debt, but you got to look at those things in the right way and say, how do those things really help me? But then it gets me down to just the pure concept of, am I doing what the customer needs in the marketplace? And can I then go faithfully execute it day in and day out and then go win the next customer?
Excellent. So we have a few questions here I want to get to.
Sure.
Would you evaluate acquisition opportunities differently, as COVID would have likely skewed numbers in one direction or another? And if so, how would you recommend factoring that in?
Yeah, so there was a shout of glee amongst the private equity community when the lockdowns occurred, because they had been facing a pretty difficult business acquisition market of high premiums being paid when they were sitting on a lot of cash. and they were thinking, yay, we're finally going to get some deals. Every client that we've had probably 5 or 6 clients that have completed sale transactions during COVID, all of them at significant premiums. There is no discount. I mean, unless you're buying assets of a business that's shuttered, in a fire sale. But here's the thing. So, many of you know, so we've been tracking a 100 company model so we take 100 of our clients' data that we have on a regular basis, and we put it in a big aggregate model. And because we see the data exactly the same way for every business, it's easy to aggregate for us. And we've essentially scrubbed the data to make sure that there's no distortions. As we looked at that data, this 100 companies is about $1 billion of revenue, and it's companies, because our practice is not geographically limited, it's East Coast to West Coast, North to South. I mean, so these are companies, all different industries. And what's really fascinating is, this 100 companies was growing at about an 8% growth rate coming into COVID, coming off of about a 22% growth rate in 17, about 12% growth rate in 18, and then about an 8% growth rate coming into 19. Now, there's a lot of people that will issue, some type of an idea of why what's happening to that growth rate. I'll tell you the number one reason for the growth rate declining was we were out of labor. I will tell you one thing: there is no economic output generated without quality labor. And when you get down to the bottom of the barrel of the availability of quality labor, you cannot increase output. And so it just is, and it ties into our philosophies about labor efficiency of both direct labor and management labor. Well, so we hit COVID, and we saw April was dropped 25% from the previous year. May was down 10, June was above the previous year. So you kind of had a little bit of a bounce coming out of lockdowns. And then July and August were down about 10. And then September was back above a little bit, before the previous year. So the third quarter of 2020 was only 3% down year over year from the previous year. Guess what? They made more profit with 3% less revenue in profit dollars. Profit percentage was up about 3%, for this group. And here's the thing: of the businesses that are directly affected by COVID, this has been a horrible year. If you're a restaurant that's been shuttered and restricted from operation, if you're in the travel industry, if you're in the corporate hospitality industry. But the thing that probably the inconvenient truth is the vast majority of businesses are having their best year ever. And not only that, this 100 company model, here's the thing, and our clients have heard this on every call that we've done: there is more cash sitting, waiting to be deployed at every level in the U.S. economy in the history of the U.S. economy. And there was an article in Wall Street Journal about 2 weeks ago that talked about all of a sudden these public companies are going to be flushing out dividends at record levels, partly because of a tax play of thinking that Biden could raise the dividend tax rate, but partly because they got money that they don't know what to do with. Then you come to the private company level. So this is what we have data on. So this 100 companies. So our signature measure of core capital. So cash minus line of credit. Well, in that particular measure, those 100 companies had $30 million of cash minus their line of credit. They got $35 million of PPP funds. $5 million was used to clean up some AP. So they jumped from 30 million to 60 million after PPP hit in April and May. That number grew from 60 million to over 70 million by September. They continued to retain profits, and cash continued to rise. Client to client to client, this is the best cash position our clients have been in ever in the history of us looking at our clients' positions. And I think that, there's some people that obviously don't enjoy that, but I think that is generally true, for the vast marketplace. And so as you get prepared in your plans and thinking for 2021, as soon as restrictions, we haven't been in a recession, we've been in a restriction. And so it's not a classical recession from the standpoint of that mindset, because there is demand when it's allowed to be in demand. And it's ready to be released. Here's the other thing on the personal side. Woe is me, horrible, COVID. Personal credit scores have gone up 3 points in the last 4 months. So even on the personal level, you're seeing people are in better financial condition. Yes, there's people that are directly affected that have horrible outcomes, and those people need directed help and effort. But there's the vast majority of folks that are actually in pretty good position. And I think, the private equity guys, everything we're seeing, they're loaded for bear with cash, but they've realized now that they got to pay premiums. So there's not going to be that. So when you go, if you're in a position of acquisition, the first thing I will tell you, if you're buying something at a discount, it's probably got some skunks in the woodpile. So you kind of want to be careful of what you're buying. Because if it's a decent business, they're getting a 7 to 10 times EBITDA. I haven't seen a deal less than 7 times EBITDA probably in a long time, and many of the ones have been closer to 10. In that process.
Got a question from Mark here. Mark, appreciate you being patient. In the book, you mentioned that a 1-month core capital target can work if a company has a strong client billing. How do I know if this works for me? I have a do stuff subscription model where clients are billed via credit card up front on a monthly basis.
I mean, that would be the, an equivalent. You've got a contract, you've got a controlled form of payment that you control. I mean, obviously they can renege and pull it off, but you're not likely to have a mass exodus. So you could get away with that. I'll still tell you, here's the thing. I was vindicated with my 2 months core capital target when the PPP program got released. Guess what the PPP program was based on? Payroll of 2 months plus another 0.5 to account for operating expenses. If you do 2.5 months of payroll, you're pretty darn close to my 2 months core capital number. Now, our clients who were sitting on that number already, they just got a nice windfall. A lot of our clients who had not been diligent to do that and had probably raided the cookie jar a little too often, they got a get out of jail free card. And many of them are starting to say, hey, I'm not going back to the way I was. I've kind of gotten used to this idea of having cash. And so you can get away with one, but I'll tell you, if I'm doing your return on invested capital calculation, I put 2 months in there in the ROIC calculation, whether you have 2 months cash or not, because that's what I'm going to hold you accountable to for your profit model.
Brian asks, Greg, what would you pay close attention to within your book if you were working with a real estate agency plus real estate investment firm?
Well, I mean, from a real estate agency standpoint, I mean, that's a service model. We've got a couple of those that have just had phenomenal years, and those are just business models to say, you're trying to generate margin. One of our best examples is a client that he owns an agency, and his goal was to not sell any more houses. And so he put the plan in place, put the people in place, got a strategy in place, and he is actually making more money now with him not going on a single appointment, and he's running the business. Now, the thing that made a difference is he understands the concept of effective marketing and managing his operating expenses to match the income that's being produced. And so, in that particular case, what you're looking for is you've got to understand your profit model. In a real estate agency business, you don't carry a lot of trade capital, so your investment is more so in your investment is more so what we call launch capital, of making good bets of your expenses. And so this is, in the book, I talk about the 4 types of capital being trade capital, infrastructure capital being fixed assets minus debt. The buffer capital is your cash, but there's a 4th capital that hides on your P&L called launch capital. And I think for businesses that are service oriented, that launch capital piece is important, because launch capital is an expense in my business today for something that I'm going to make happen in the future. And so I'm diminishing today's profit. I didn't need to spend it to get to today's profit. I need to spend it to get to next year's profit. That is, in essence, a capital expenditure, but it gets counted in accounting terms as an expense. And so what we like to do is strip that out of normative operations. And there's a couple of good case studies in the book to go through examples of how we do that, to where we really hone in. There's a great example of a company that grew from, it's a client of ours that let us share their data. and this is their actual data. They grew from 700,000 to 10 million in 5 years by deploying effective marketing spend. It was just a phenomenal story. Great entrepreneur. But it shows the example of being intentional. Of I am going to spend this because I don't need to spend it for what I have. I need to spend it for what I want to get. But I need to hold it accountable. And that spend wasn't effective every year. I'll share with you that. There was one year they missed it, but they learned from that and they recovered from that.
Awesome. Alan asks, how do you think about attributing causation to investments? Danger I see is spending on marketing or sales and you grow for some third reason, but it's hard to tell since you can't hold everything constant.
Don't know. I mean, the challenge with, and this is a challenge, especially in marketing spend, people spend it and they go, well, can you prove that spend caused this? And sometimes you can, sometimes you can't, so we typically look at, my favorite effectiveness measure of marketing spend is looking at contribution margin on a rolling 12 basis to marketing spend. And I'm just looking at that as a trend and say, is it getting more efficient? Is it getting less efficient? But I can't tell you, I can't draw a direct correlation. And some of the people who like to convince themselves that they can draw that direct correlation, I'm not quite so convinced that they can. I think this is where the entrepreneur earns their stripes. I mean, you got to look at it and be honest and objective in terms of saying what works and what doesn't. Now, if you are active in marketing spend, you can do some A/B testing. I can go through periods of turning off a marketing program and seeing if it affects activity. And then I can turn it on. I can change a message, so to the extent that you can get some resonance. The problem is it's a constant moving target. And so in the case of what works today, and this was the case study of the 5-year example company, is what worked for a while stopped working as well. And so they had to adapt. And also they broke the rule of, so when it comes to marketing spend, there's 2 approaches. I can either take one step at a time trying to find the edge of the universe, or I can take a big leap. Now, what's the risk with taking a big leap? I sometimes jump off the edge of the universe and I die. And so it's kind of one of those things of going, well, just how desperate are you to make that bet? And a lot of times as you were able to kind of nudge your way, but be aggressive, keep pushing the limits as long as you see it working.
Alan wanted to follow up. If you were 30 and couldn't do accounting, what type of company would you start or buy?
I do something I was interested in, because I don't know. Never thought of it that way, in the sense.
Chicken farm.
Yeah, it wouldn't be a chicken farm. I know that. That part is that ship is probably sailed. But I will say this. I mean, the thing is I don't feel like I have to work every day because I really, kind of tell I kind of like what I do. I find it interesting, and so I would probably do some type of consulting. Just because. Because not only did I look at creating this information, we're still in the same game that everybody on this call is in. We're building a business. And so, my goal a long time ago when I hired Brandon Gray as my first guinea pig of seeing if I could teach somebody how to do this was, can somebody else do it? And the thing I am so proud of our consulting team is, when you hear them give calls and people say, when they hear one of the other consultants talk about something, you hear a very consistent refrain of what we talk about. And so I'm really proud of our team to be able to consistently apply a philosophy rather than everything is a one-off, kind of unique thing.
All right, I'll dismiss the comment about being a bobcat breeder, but let's go to something else here. Would you strip out launch capital, specifically marketing and cost of Salesforce, as a form of calculation for return on investment on your marketing?
Absolutely.
If so, would the same 50% hurdle rate ROIC would be relevant?
Yeah, absolutely. And this came from a client example. I have to give one of my former clients who ultimately sold, but they were a software development company. And so each year, being a technology software development company, the rule is you're not allowed to make profit. You're supposed to reinvest everything to grow. And so I started this process with them 6-7 years ago. And I said, okay, we're going to do this exercise at the end of each year. We look at their P&L and said, what did you spend this year that had nothing to do with what you're currently doing this year with the work that you have? And we extracted some R&D, some of their software dev people that were working on new features and those things. And we extracted their sales and marketing team. And at the end of each year, it was about $1 million. And at the end of each year, I'd ask them, says, well, what did they accomplish? Nothing. Really? No. All the sales that came in because of other relationships we had. These are features that the customers haven't asked for. We just kind of think they would be good. I was like, we've got a client that picked up this year. Actually, got a call with them later this afternoon, and they've had just a phenomenal sales growth year. I mean, just off the chart, crazy good. And so they had come off of terminating all their external salespeople or their extra salespeople. This is, there's kind of a core group of people that have been in the business, but they had brought on some salespeople trying to grow. You guys have heard this story, right? You bring on salespeople, try to grow, didn't grow, fire all the salespeople. Okay, bring in a whole new set of people. Now, here's where correlation and causation come in. This company goes from about 20 million in revenue to 80 million in revenue. And I ask them, okay, with this 1.5 million of salespeople that are getting compensation now, how much of that 60 million in new growth did they cause? Crickets. I said, well, the sad news is we could have sold all this without that 1.5 million. And this is the essence of this launch capital philosophy that we have. We isolate catalytic spends. I don't care about the reactionary cost and other stuff. I want to know the labor and any direct marketing spend of these catalytic things that we spend to grow our business. And then if I spend $1 million, I need to see profit increase by 500,000. Now, here's the part that everybody loses. If profit increases by 500,000, that means that I covered my cost and I made 500,000 more. I didn't just get 500 of the million back in that process. And I need to be able to show cause that I can do that within 12 to 24 months. I'll give you 12 to 24 months. If it gets beyond 24 months, you're betting in a pretty big game. Now, the only business that we consistently deal with, we have some personal injury law firms as clients, and they arguably have to carry on average about 3 years of their operating cost in a case before that case is on average going to settle. And that's just, I haven't come up with a way to figure out how to make that. There's people that will finance that, but that's not solving the problem. That's just a funding mechanism that costs you something. And so that's just the nature of that business. So it requires that ability to build up to that level of capital to start turning over that level of cases.
All right, good. Real quick question and answer here. If you're placing a bet, are you betting that the PPP forgiveness will ultimately end up untaxed as it's the easiest form of another stimulus for small business?
Well, I've been regularly saying I think there's a 50% chance that Congress will slide in some tax-free language in something that will get passed before they adjourn. But as every day passes, I keep looking at the news reports. I don't see any language. There's a couple of bills that have it in it, but there's a lot of horse trading that goes on in the last minute, and that's probably not my area of expertise. But I still kind of hold out that I think there's a 50% chance they will overtly state it. Now, if they don't address it, I think it will eventually be deemed tax-free, but it'll have to go through tax court, which means 2 years from now you'll find out, and then you'll file amended returns to recoup your tax. And if if Congress is smart, they'll overtly rule one way or the other to avoid a bunch of amended returns in tax court cases.
When calculating the cost of direct labor, why don't you include taxes and benefits?
Simplicity. We like simple numbers. I want to, our client zero was a landscaping company. Chris Anderson at Sunco in Nebraska, and we were working with Chris's company, and he had a 4 labor efficiency ratio for his irrigation work. He had a 4 for his landscaping services. He had a 2.5 on mowing. And so he was sharing this information with his team. And one of his mowers, who was making $10 an hour, kind of piped up after he shared the information. And the guy said, "Well, looks like to me we shouldn't be in the mowing business." And that's the whole reason, because if you've got to do mental Olympics to calculate a number, it's not very effective in getting your team or even you to effectively utilize it. Let's face it, if you've got a 4 multiplier, inside that 4 is the recovery of payroll taxes and benefits. But here's the thing: if you take payroll taxes and benefits and spread it out all over your P&L, you lose track of it. You don't know if it's going up or down. And if you keep it together in its home, you can actually look at it as a percentage of all labor and say, do I have, benefit creep, that is unintentional. And I mean, this whole idea of loaded labor sounds great. Here's the reason why accountants use loaded labor. It's a pricing convention. It's not a good accounting convention. You need to focus on directly associated cost of every economic activity. And then what you're trying to do is get the net margin out of those directly connected costs. The sum of that margin has to overcome this burden that sits down here that is just your cliff to get over before you start making a profit. And to me, I mean, if it works for you, great, but I will tell you that more people have been fooled by the burdened or loaded cost labor methodology than helped by it. So in my opinion.
So I'll follow up with that. And so when you're working with clients, how do they go about setting that target to cover those operating expenses that include payroll taxes and benefits?
So this was the unknown. When we stumbled on the 5 magic buckets of operating expenses, I was doing my first data aggregation for the first book, and I had to kind of come up with a group of consistent categories to kind of aggregate the data in. And we settled on facilities, marketing, management labor, payroll taxes and benefits, and then other OPEX is the big catch-all bucket. And what we now realize is it was just kind of a serendipity it was the magic of the connection. Those are 5 functional cost buckets that make it, once you put them in those 5 buckets, they're very easy to predict. Facilities is largely a fixed cost that only changes if you act on it. Marketing is a decision-based spend. You can either spend something or nothing. Management labor is a decision-based spend. Who do I want to hire? I can stretch. I can hire early. I can hire late. I can deal with that. Payroll taxes and benefits is the purest variable cost that you're going to have on your P&L. It's just a percentage of all labor. And what's left over is this catch-all bucket of the noise of business, everything else that doesn't in those other 4 categories. And what you start to realize is other operating expenses on a rolling 12, on a monthly basis, it does this. On a rolling 12 basis, it does this. And it's what we call a lagging variable. It's going to eventually stay pretty consistent to either revenue or contribution margin, pick one of the two. It's going to stay pretty consistent to that number. And so I will tell you, in planning session after planning session after planning session, the number one number that we focus on to get people back to profitability is contribution margin. So listen, unless you got people sitting around doing nothing that you don't need, and that's a pretty quick decision to figure out, operating expenses are pretty easy to predict. It's getting to contribution margin. So if I got $2 million of OPEX, it's pretty much baked in unless I make some harsh labor moves in management labor. It is what it is. And so I got to keep going back to the drawing board to produce a contribution margin that gets me above the 2 million and an acceptable level of return on invested capital is the targeting mechanism that we now deploy. And it's not rocket science at the end of the day.
Ken, I'm getting to your questions. In a purely direct-to-consumer e-commerce business, does digital advertising cost apply as a capital or expense?
So in direct-to-consumer, we've now kind of adapted to where your direct-consumer advertising, activity-based spend, you're buying AdWords placement, whatever, we consider that a COGS. And it's so there's a product margin, yes, that you'll look at, but there's like a when you're doing margin analysis, you're doing kind of a multi-step of margin creation. But I think if you're in an activity-based marketing business, we've kind of settled on that. We believe that number is best considered a cost of goods sold, because ultimately it is a cost of it's no different than shipping. It's no and it has a less than 1 month shelf life in 99.9% of the cases.
If the ROIC is inherently healthy because of the structure of the business, how do you prioritize the effort level appropriate to improve it? In my case, e-commerce.
Well, you would look at it and say, this is where you kind of go through your strategic planning process and say, what are the blockers to growth? Is it, so, in the new book, I start with a simple mindset. I said there are 3 rules for simple business success. Figure out what the market needs, find a way to do it profitably, and then can the profit equal a 50% return on invested capital? So when you're looking at what are your blocker, if you desire to scale, so let's start there. I mean, I'm showing you a game plan of how to scale smartly. Now, not every business wants to scale. There are things that scaling causes you to have to deal with that you may not want to deal with. And so I'm the first one here to tell you, it's not my decision for you to scale. It's your decision for you to scale. My job is to quantify the impacts of scaling and getting through the black hole, or getting through to that next level, going from geographically centric to non-geographically centric in the broader locations and so forth. Those are all consequences, of that scaling. But if you decide to scale, you got to look at it and say, what is keeping me from scaling? Is it my execution? Is it my supply chain? Is it my ability to fund? One of our direct-to-consumer retailers on Amazon, I mean, they're a little bit resource challenged at the moment, but they're working their way up. And, and it's one of those things that as much cash, every time they get dollars of profit from turning over a solid month of activity, they throw those dollars back into more product. And it's a guessing game of which products do they put that money in, and which products do they buy marketing spend to produce. And so what we've kind of developed is you've got to look at the margin model plus capital, inventory. Do I get terms from the vendor? And you can really get down to an economic model by SKU if you really have access to the data. That's super powerful for you to understand what are the things that generate the highest, best leverage, in that process.
In the book, you say that for businesses with a higher gross margin, it comes out in a range of 6 to 10 for revenue.
Mm-hmm. Yeah.
If the company's gross margin is below 40%, it hits the same range for gross margin dollars. It always shocks people to see this, and it gives them a new perspective on why they need to hold management more accountable to deliver contribution margin, just not revenue. And can you elaborate on that?
Yeah, this is another one of those patterns that we saw more of it as we just started getting more and more clients and kept doing this calculation. But every client we do this build up. And we say, at your optimum level of profitability, if you add $1,000 of management labor, what do you have to get in revenue to stay at the same rate of profitability? And when you work up, so you take the management labor times the management labor efficiency ratio, that tells you contribution margin. Once you know contribution margin and your direct labor efficiency ratio, you can back into the direct labor variable amount that it takes to add to that. And then you work up to your gross margin percentage and you back into revenue. It's between a 6 and a 10. The average is 8. But I would tell you, for planning purposes, if you don't get 10 times revenue for every dollar of management labor increase, whether it's a raise, a bonus, or a body, it's probably not a good idea. And the only time now it can jump to like 20 something as a multiplier if you, like, we've got a client that's at 15% gross margin. Their number is going to be crazy high because really gross margin is their true top line. And so they're going to be a 8 to 10 to 1 to gross margin. And then what supercharges it up to revenue is just because they're a low margin business.
Do you believe in open book financials in a company, and when should a company consider it, if at all?
Yeah, great. I mean, I'm a huge fan of open book management and Great Game of Business. Before we merged, we were able to share 100% of everything. We didn't even hide salaries. I mean, we didn't go out of our way to put it in front of people, but we didn't hide from it because my philosophy is this: I would rather deal with truth than I guarantee you what somebody thinks the number is because they don't know what the number is worse than them knowing what the number is. So that's kind of, where I come from. Now, here's the thing though, you can, by putting it in front of folks, you do kind of generate some activity that, you kind of decide, do you want it? And so my 2 rules for open book management is this: the owner has to be able to defend the data. I can coach you up. My team can coach you up. We can help you learn to explain it. We can run you through and have you do a sample, defending of the numbers, session, and see, what do you have clean and what do you get confused on. But you got to own it in that process. And if you can't, I'd be careful how much I share. Also, the second big rule is you can't have any protected species on payroll. And so if you've got, your college roommate's friend or, a family friend that you've kind of made up a job for, or, you've got people that are making money that is inconsistent to other people, whether you share detailed salary data or not. The fact that you're using the business in a way that's your own personal piggy bank, you will get farther in life by not doing that. If you want to do something with the resources of the business, take a distribution out of the business and go do it over here, that's not part of it, because it confuses your people in that process. They think they think you spend everything in your house out of the business, and hopefully you don't. But here's the thing, in a practical sense: you don't need to share everything down to profit. I'm convinced from years of doing this that every business can share down to contribution margin. And as I said earlier, 99.9% of the time, contribution margin is the most important number to get your team. That's the number your team can impact. You make all the decisions on those OpEx in reality. Very few people, make the call otherwise. And so pretty much, if you get people focused on contribution margin production, and those of you that we do bonus programs for, that when we run the Great Game of Business, similar concept to their incentive model, our critical number is contribution margin performance, because I haven't seen a number that's better than that to get people focused
on. When compared to market returns, the ROIC of 50% is a lot higher than what the private equity market makes on their invested capital. Can you help explain the difference?
Yeah. So public companies generally operate, this was kind of what I learned from David Wessels at Wharton. Public companies operate between 15 to 25% return on invested capital. And that's an after-tax number. The number I'm talking about at 50% is a pre-tax number. So if you really take taxes out of that, you're probably looking at about a 35 to 40% return number. And so at that level, you're because of lack of marketability and risk factors of being smaller and those things, that kind of makes up for that practical difference between the two. But here's the thing. This was what shocked me, is when I started studying this, and I go, okay, 50% is the minimum. You know what the average return on invested capital is? It's about 75 to 100. And this was an important concept because I've seen this happen time and time again. Client starts to make some money and they go talk to an investment advisor, and the investment advisor in good logic says, oh, you got all your eggs in one basket. You don't need to keep all that cash in your business. You need to put it to work for you. You need to diversify. You need to take that money out of the business. And said, listen, dude, there ain't nothing an investment advisor can help you invest in that will grow more and produce more return than a properly capitalized business that's profitable. Here's our best model that we see over and over again. That we have quite a few clients in the IT managed service provider industry. It is by far the best capital profit model that we work with. because they generally get paid in advance for their recurring service, and they've all learned to actually bill a little bit in advance for any projects that they do, they generally carry zero to negative trade capital. So their only capital input is their 2 months of cash. When they hit the profit, most of them, we strive for that group to hit between 15 and 20% profitability. And when they hit our profit numbers that are targeted labor efficiency ratios for that industry, they work at a 200% or higher return on invested capital. I'd say that's a pretty good investment. So their deal is, how do I effectively deploy launch capital that's effective to go win the next customer and get the next client and grow and grow from there.
Awesome.
So you tell me. Where are you going to go get 100% return on something that's legal?
We have about 8 questions left, so let's knock these out. Get everyone back to work. With such big emphasis on labor efficiency, are your clients able to pay market labor rates or more to keep talent? And can these businesses be great places to work for the right people?
Yeah, I 100% believe so. Here's the philosophy. I'm willing to pay a market wage, and I get to demand market performance. Simple as that. So if you can't go, if you want that way, that's great. But now I need you to perform to it. And if you don't perform to it, you can't work here. I don't care what you do. And so what you've created is a fairness doctrine that says, and so you look at the career labor efficiency curve. The goal is you keep pushing people up until they hit that point that person really can't produce anymore. That's usually where you've got to have the more difficult discussions of that person really can't keep getting raises because they can't. Either they have to figure out or you have to help them figure out how to produce more if they want more money.
Do we work with any call centers? Have you seen their direct
Yes.
labor efficiency increase?
Yes, we've worked with them, and it depends on what you're doing. So a lot of that is also client selection and whether or not what value you're adding. And so once again, call centers and staffing companies are very similar in business model. And so what labor efficiency tells you is what is the respect of the market versus the dollar that I paid the person. So if I'm a staffing business that's getting $1.50 on $1 of wages paid, that 50 cents represents 10% of minimum essential payroll taxes and benefits. And the other 40 cents is what they value of, I found the person, I run their payroll, and I'll replace them if you don't like them. And then that 150 starts to go up from there of, am I managing that person? Am I, adding any other value to what that person does? And so like in call centers, are you just doing unskilled answering and routing? Or are you adding technical assistance? And some of our clients in that industry that get really high multipliers is because they've got people that are very good at assimilating instructions and technical support in that process. And you move down rate, as you start to see people that are just performing a unskilled function.
Someone just said, "See, please do a webinar again in the future." Great insight. So there we go. Got that one. What generally is your cost of chassis as a percentage of your gross margin or revenue? Also, is there any geographic difference between the U.S., Canada, Australia, UK, or is it relatively constant?
Yeah, I haven't seen much difference, across the globe. I got to do some presentations in East Africa and the Middle East back this past spring before COVID hit, and also last summer. And I will tell you, emerging economies, their biggest issue is speed of margin through the business cycle. So you have long terms and very little trust in that turnover of AR, inventory, and AP, and the netting of those things. And so I constantly believe a third world economy can become a first world economy if they just have a trust system of payment and everybody work faster to get cash through the system. What the U.S. and Canada and Australia enjoy, mostly and definitely U.S. though, is what's happened in the last 15 years is $1 of margin flows so fast through the system that we've become a much lower capital requirement business economy than we ever been in our history as a country, in that process. So I think that's really kind of the key. But if you look at a consistent, I would say in terms of a number that pops up more frequently, roughly somewhere between 35 and 40% of revenue is kind of a normal expected number of operating expenses of the chassis of a business, to revenue. But there again, be careful. Once again, I don't really care what it is as long as it's producing value. So there's a chapter in the new book is my ode to my distaste of budgeting. And so I hate budgeting. Budgeting is a license to spend. It's not a lot. I need to spend money to make money. And so I call it, the value-based spending philosophy, in the sense that, and this is what we saw in COVID. The reason why those businesses were more profitable in dollars with 3% less revenue in our COVID model is because they looked at every expense from people to things and made a harsh decision of what adds value. Now, the thing is why did you need COVID to hit before you did that? You should have made that decision before it happened. And that's what I want everybody to keep in mind going forward, is we don't need to have a disaster or pandemic for us to make good value-based decisions. But case after case, it was interesting to see businesses look at things that were fluff and not necessary and just cut them out.
Awesome. All right, let's try to get two more in here. I apologize. There's a bunch here. Trying to get to as many of that as we can. How do you help upcoming entrepreneurs focus on becoming profitable and grow with their own cash when there's so much hype behind VC and PE startup money in business?
Well, I mean, most of the people, we go through a calculation and say, well, if you want to grow this with other people's money, and we had a project here just recently of a client who'd actually gone through and raised some VC money, but we kind of helped him remodel his business as if you really weren't taking on any investment, here's how to make that business cash flow positive without that investment. It's not my decision for you to use outside money or not. I'm just telling you that, there's an alternative. And the question is, are you more concerned about the revenue number that you're going to drive to, but you won't own the company when it gets there? Or do you want to have more net value to you and with a smaller business, but you get to call the shots? And oh, by the way, if you meet that cash power ratio curve to where you can grow from your own profits, why would you ever want to deal with a private equity guy?
All right, last one here. I've adopted LERs across my company, and in one office, the operations labor LER is far lower than the other offices. However, the management labor is much higher, making up for that lost margin. We have had a hard time explaining and pushing the operations LER, as at the end of the day, the net profit is still on target. Recommendations on how to push that, or should I just lay off a bit and be happy that we are hitting the true target, which is profit?
Well, so it becomes, it depends on what you want to have happen in that office, because what we see is if you have a high management labor efficiency ratio, you have an unscalable model, because that's your management labor are performing the functions of direct labor likely and hiding it from you. And that's the reason why, that you got too much labor doing stuff, and that labor is ineffective because management is actually not helping them be effective. They're being a blocker. And it looks great on paper. I mean, you can apply, there are cases where we'll say, listen, if you don't really care, you can do the simplified overall labor efficiency ratio, where you take direct labor plus management labor and divide that into gross margin and say, how do they compare from there? But there again, you got to look at it and say, when I'm running management labor hot, that's telling you that you're not in an attitude of growth. You're in an attitude of getting by. And once again, I'm more inclined to get my management labor, to get that direct labor optimized and repeatable in making it churn, so then I can actually scale the business. But when I have the managers that are the savior to the world and they fix everything, yeah, it'll be profitable, but it ain't going anywhere.
All right, one more. I didn't read this one. It's been up there for a while. Can you comment on how funding a cash balance plan as financial intelligence?
Funding a
How funding a cash balance plan as financial intelligence, or benefits of doing a cash balance plan?
I mean, if you're talking about like a retirement plan.
Yeah, I'll have to see if he responds back. Yeah.
I mean, if you're referring to a retirement plan, here's kind of my, I'm a little bit different than most of my peers. For your employees need access to a 401k and all that kind of stuff. I want the entrepreneur to put as little to nothing into that plan as possible, because you're talking about big money as the owner of the business. And I generally believe that after tax money that's free of tax burdens and tax limitations is the most flexible way to do things outside of the business. And you can do some of that inside. One of our clients, JP Dotto Advantage Retirement Systems, they do directed IRAs. And I've used them, to take money out of retirement plan to do some alternative investing, and they do a great job with compliance and those kind of things, to where, that's the kind of thing that you may decide to do, because the vast majority of entrepreneurs that we work with don't really trust the stock market or mutual funds. And so they're generally wanting to invest in some type of alternative investment or real estate or some of those kind of things. And when you start socking away cash flow into a retirement restricted account with IRS regulations and all that, you sometimes tie your hands in terms of what your ability to utilize it and how you deploy it. And so I'm just much more of a fan of entrepreneurs building their wealth externally to the business. Once the business is fully capitalized and if you throw any more money at it, it's going to be wasted. Okay, well, in that point, we're going to harvest that wealth and we're going to build wealth externally. And I'll put my plug into the goal is to get your house paid for and have no home mortgage debt, because that's the number one security measure that every entrepreneur ought to strive to.
Great.
I'm batting 1,000 on that one. So.
All right, maybe this beats the bobcat breeder, but it sounds like your business would be a managed IT provider. Hey,
not necessarily. It's no, too much customer service.
3 questions left. Speaking of budgeting, any books, seminars, etc., on how to do proper forecasting?
No, I mean, I've not run across any, so to speak. I mean, it's probably something that would be kind of a good future, webinar topic, probably do an extended version of kind of how you're doing it. Because essentially you come up with a target and then you take that target and you come back to the present. And one of the things, like one of the models I was working with a client yesterday, if you're planning a growth curve like this, well, the growth rate that I'm at 12 months from now is vastly different than the growth rate I'm at today. And so really trying to work on those, is really kind of the key of how you got to always come back to that monthly approach to it.
Alan asks, sounds like you'd be cautious about buying companies today with such high multiples.
It would, and I'll give you kind of the quick reason why. So if my target is a 50% return on invested capital, if I buy a company at 5 times EBITDA, that's an inherent 20% return on invested capital if it stays where it's at. Now, if for me to get close to that 50%, I've got to grow that business 2.5 times, because if I can grow it, then what you're looking for is a business that doesn't require it's neutral on trade capital. So I'm looking for a business that meets that center line of that cash power ratio. Those are the ones I'm interested in, because I don't have to keep throwing more capital at it to grow. I just need execution. So if I'm going into an attitude of doing an acquisition, I'm trying to go buy companies that don't burn cash when I grow them, would be my first choice. And so if I can get a company like that, then if I grow it 2.5 times, I'm now at close to a 50% return on invested capital, because what I paid for it, I didn't have to add to it to grow it. I just kept retaining my own profits. If I pay 10 times EBITDA, that's an inherent 10% return on invested capital. I got to probably 5x it in growth. And so what you have to look for is, it's okay to pay a high multiplier if you have the ability to you got to decide, do I need to 2.5 exit or 5 exit to make that investment pay off. And that's when it pays off. But to go buy it, to just keep running it like it is, that's not too exciting. Unless it's, now the one other example is what we call a strip sale. So if you go buy them and you buy their contribution margin and you can strip off all of their operations, both their contribution margin onto yours, then you're measuring your return against contribution margin, not net income. So you might pay them a 5 times EBITDA, but you really paid them a 1.5 times contribution margin. And if you can bolt it on and get rid of all their other costs and just make that accretive to your performance, those are the deals that will work.
All right, last one. Do you recommend utilizing a net present value calculation when assessing how to deploy cash for initiatives?
No.
There we go.
So, and the reason being, so I'll give you a prime example. We got a client that's launching a new business. And so what we do is when you launch a new business model, what you're doing is I'm trying to say, what's my upfront investment and what are my operating losses? And for my upfront investment and my operating losses, when do I turn break even? And so then I sum my operating losses and my upfront investment, and that's my invested capital. And then I take that invested capital, multiply it times 50% and say, now, can I get to a run rate of profitability between the 12th and the 24th month that is a 50% return, against that original investment? The net present value thing just doesn't work, in my opinion. To me, that's what works. And our clients who we've deployed that concept to, I mean, they get it like that.
Awesome. Well, all right. Well, that's it. I appreciate it, everyone. Great questions. Much appreciated. I will be pushing this recording out on the YouTube and LinkedIn and in an email to all of you. So it'll be all over the place. And so again, thank you very much, Greg. Much appreciated. I'll walk by in 20 feet and high five you in a second.
All right.
All
Thanks,
right.
guys.
See ya.
Bye-bye.